receivables. Who owes us money? Accounts receivable or trade receivables are recorded when services are sold or provided to customers. Accounts receivable is an operational asset. It relates directly to transactions between a customer and the company. They are basically extending credit to our customers to give them time to pay for the services or product that we have provided to them. It is an asset. Trade receivables is what you get when what is owed to you by a customer maybe, and you get something else in return, a trade. It's almost like all about your service or your products that you're providing to your customers on credit, meaning they are going to pay you within a reasonable period of time. Like accounts payable, it is very much a very short-term asset, because we're expecting to receive on our receivables within 45 days, most often 15. So the net realizable value is the amount that you expect to receive, period. And with receivables being so current, so close to liquid, because it's a very, very current asset, the net realizable value is almost always going to be the exact same amount of what you're providing to that customer and what you guys agreed on. So very little changes in value, which is very much like accounts receivable. So the net realizable value is almost always going to be the same as what you actually bill your client. However, because we have to make certain that when someone looks at our financial statements, they can say with a lot of confidence that if the receivables on the books for $10,000, then that's the net realizable value. That's exactly what we expect to receive in return. However, assets do age, and receivables is one of those aging. And if you're thinking that your clients may default, or that there's a reasonable expectation that you're not going to receive all from your clients, you're required to take a guess using the allowance method to consider the possibility of one or more of your clients are not going to pay you at all, or they'll pay you less than what they're required to pay you. The allowance account, or accounting for your receivables net of an allowance, provides the user of financial information, the rock bottom net realizable value of that asset. We are assuming that because we are expecting $100,000 from our clients, there is a chance, given the nature of our work and given the nature of the type of services that we're providing, or the product that we're providing, and past experience, there is a chance. It may not necessarily be remote. It may be a real chance that we may not collect 100%. The allowance method allows you to create an estimate of what you believe may default, may go bad, may not be collectible from your customer. And there are a number of ways of doing it. Now, the example in this particular slide is fine, but I want to just talk about the logic and the accounting for it in the FASB records. We have to create an allowance of what we think may go bad. Now, GAAP reporting says we have to use the allowance method, which could very well be the balance sheet method. It could very well be the income statement method. But in the end, the two approved methods of evaluating and estimating what we think we may not receive is essentially saying, I'm going to use the sales method, which is the income statement method. And I don't believe all of my sales are going to be collected. It's not reasonable, given the nature of our work, that we're going to collect all of our money. So I'm going to use the sales, a percentage of sales, and estimate what will go bad, my bad debt expense, essentially what we're doing. The allowance method is going to be also the balance sheet method, which is going to be the aging of receivables, or the percentage of receivables that we might not collect on. In the end, the balance sheet method is looking to create this allowance to match what we think we're not going to get. So if we say 10% of our accounts receivable will go bad, and we received $1 million in revenue or $1 million in receivables. So we're thinking $100,000 is going to go bad. That's what our allowance should be. So we have to match what our bad debt expense is going to be, because at the end of it all, we want to make certain that our allowance in that contra account equals $100,000. So you basically have to back into what your bad debt expense is, which is conversely different from using the income statement method, which means 5% of my gross sales or 5% of my credit sales are going to go bad. That's going to be my bad debt expense. Two different ways of looking at how we create that estimate. This is not saying that they will actually go bad, because we're going to talk about what happens when you determine that only this actual item is physically bad and we have to write it off. And we'll talk about that. But we're creating an estimate. Why? Because we want to be able to show on financial statements the net realizable value of our asset, in this case, accounts receivable. And to do that, if there's any possibility or any chance outside of it being remote, because remember, if it's a remote chance, we ignore it. We don't record, we don't show anything if it's remote. But if there's a chance that if our receivables will not be collected, that is requiring us to use a systematic method by which to estimate what that value is and look at it every year to see if that estimate is close to reality. So, estimating the liabilities. Again, we're taking this, I don't want to go through a whole lot of detail on the slides because I really want to just talk about what the allowance method is and why it's so important. So now that we know that the net realizable value of our asset for receivables is going to be what we bill to our customers and what we think we won't get, netting that, or again reducing our gross receivable from that allowance that we think may go bad. So our net realizable value is going to be the difference between the AR minus the allowance, gives us our net realizable value. And again, this may not necessarily be applicable to all organizations. And again, our Walmarts of the world, the Targets of the world, a lot of organizations have enough experience with their clients, enough experience in their role to know and to be able to estimate with a very high level accuracy the possibility that a client of yours may very well default. However, this is just showing you what the allowance is. This is just saying this is our guess. But here we are, fast forward 6 months, and we got reality. We know for a fact that this client has gone bankrupt and it no longer exists as a viable entity. They owe us $100,000. That amount has gone to the bankruptcy court. We're not going to get much, if we get anything at all. That particular bankruptcy filing should be more than enough evidence to say this asset needs to be completely removed from our books. It's highly unlikely we're going to get the money. Highly unlikely that they're going to have any money after all the other creditors to pay us. We're going to take the proactive step in saying bankruptcy is sufficient reason for us to say, boom, we're writing this off. And understanding the rules by which writing something off. We're creating an allowance on one hand. We're guessing what might go bad. And in reality is, it actually does go bad. So the allowance method provides us that way of doing that with the income statement method or the balance sheet method. But then also, the other side of the coin is the IRS says, well, what does the IRS create as a rule? The IRS says, the allowance method is highly inappropriate for us. We don't want to know all that. We only care if it was written off, if it's bad, and that's when we want to see it. So when you talk about those two different ways of seeing things, a direct write-off method is write it off when the asset is gone bad, which could be a year or two after the fact of the bankruptcy or whatever event. Or we could tell our investors and users of financial information that although we have $100,000 that we're expecting, or $1 million we're expecting from our clients, we're going to be honest with ourselves and with you. We're not going to get all that money. And in the past, we've had a 2% default. So we're going to estimate 2%. That gives us the best mechanism by which to give individuals looking at our statements a realistic and an honest assessment of what our net realizable value of our asset is, in this case, accounts receivable. So again, writing it off is going to be removing the asset completely from my books. Creating the allowance is allowing us to incur the bad debt expense, assuming that these potential customers will not pay us. So we're using the matching principle, and it's all about the matching principle, matching the expenses that we've incurred with the revenue that we've generated. Very, very simple process, but it's another expression of the matching principle. The write-off method, direct write-off method, is not, which is why it is not allowable for GAAP reporting. So when we, again, as I mentioned in this long conversation, we've got methods of doing it. I've already mentioned the percentage of sales, which is the income statement method. We also got the percentage of receivables, which is the balance sheet method. And again, depending on, which method is used, is going to give you your bad debt expense. But again, the balance sheet method is going to be highlighting and emphasizing what is the balance of my allowance account or the contra account should be, and creating, adjusting a journal entry for bad debt based on that. The income statement method is going to be, what is our percentage of sales that's going to go bad, our credit sales that's going to go bad, and that's going to be our bad debt expense. So with the income statement method is one step, and with the balance sheet method is going to be 2 steps. But in the end of the day, the statement that you prepare in terms of your allowance calculation is going to be the method that's best suited for your organization and gives you the most reliable estimate of your bad debt expense. I hope this message, this tutorial, and this little conversation was helpful to you, and obviously augments what you're reading in the chapter. Please hand any questions or any questions that you might have to me, and I will answer them as soon as possible. Thank you very much for your time, and I'll talk to you next time.